You are listening to Keystone's Stock Talk Show, episode 260.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back with you again. I kick off the show by revisiting my take on lithium exploration company Patriot Battery Metals Inc., symbol PMET on the TSX, which was universally ripped, my take on it, in the comments on our YouTube channel when I initially put that out. We will see where the stock is just under 2 years after our cautionary stance on it initially. In our Your Stock Our Take segment, Aaron answers a viewer question on Nikola Corporation, NKLA, on the NASDAQ, a company focused on developing and manufacturing zero-emission vehicles, particularly hydrogen fuel cell electric trucks for the commercial transportation sector. The viewer notes the stock is up 40% over the last week and would like to know if there is any substance behind the move. Brett answers a viewer question on Pollard Banknote, symbol is PBL on the TSX, which serves the lottery, instant ticket, and charitable gaming markets, primarily in North America, as one of the largest printers of instant tickets in both the US and Canada. Pollard recently reported some interesting news surrounding its joint venture in the US iLottery market, and Brett will let you know the potential near and long-term impact on the business as well as the current fundamentals. Finally, Brennan revisits his take on PyroGensis Canada Inc., symbol PYR on the TSX, which manufactures, develops, and commercializes plasma processes and systems in Canada. The stock was a pandemic high flyer, which crashed back down to earth, and Brennan lets you know how the business is progressing after holding a cautious stance on the stock in his last review. So let's get to the show. I'm going to welcome my co-host, Mr. Aaron Dunn, the Killer Bees, Brett and Brennan. How you guys doing?
Doing well. What about yourself?
Good.
Hot.
It is hot.
Bit of a heat wave here
Yeah.
in Vancouver.
Brennan, you had a stat on Las Vegas that it hit like 49 degrees or something over this weekend.
Yeah.
49 degrees. Wow.
Yeah, yes. I'm pretty sure yesterday, I mean, again, this comes from one of my bonehead friends that was telling me yesterday.
I shouldn't have brought this up. So it actually
would be a pretty easy thing to verify.
There's this thing called Google.
Yes, this is true. But, I just take my friend's words for it and go with it and just spread the misinformation.
Nice.
All the time. So
yes, it was the hottest day on record. Google can confirm your friend.
Good. And it is warm, but we're enjoying the weather. It was kind of at least on the West Coast here, it was a weak to chilly spring, rain everywhere, and actually not enough, just not good temperatures. But we finally got some positive warm weather over the weekend where I was down at the beach. We live close to it, so we're down there over the weekend. Aaron, did you get up to anything interesting
this weekend? No. Well, I had my vacation last week, so this weekend was
taking it easy.
Taking it easy. Yeah. So I checked. I think it got up to 45 degrees.
Is that what it said? Wow.
I'm
spreading misinformation.
Bloody friends, just destroying it. All right, let's get to the poll.
I checked. Maybe there's another day, but that's still pretty hot. I mean,
is hot as hell.
We're splitting hairs here.
Yeah, they are.
That's a bit cold. I don't know for my taste personally.
Yeah,
and it is.
What's that?
I don't know what's going on. It's a different heat down there, is all I would say. That dry heat. If it was 45 degrees and with humidity, you might as well just shoot yourself. It's over.
Yeah.
All right.
You know what's even hotter though? Our poll results.
Yeah. Oh, what a segue. What is even hotter? Let's get to that. Our poll results from last week.
Yeah. So our question was, what is your biggest fear when it comes to investing in stocks? At 37% of the votes, was market crashes, 26% company-specific risk, 15% missing out on opportunities or FOMO, another 15% fraud or accounting scandals, and then rounding it off at 7% macroeconomic pressures.
I'd say FOMO certainly drives investor behavior to a large degree, but yeah, I mean, an entire market crash is a fear. On the flip side, it's an opportunity. The markets have had several crashes over the past 100 years, and they've always been a tremendous opportunity to buy great companies. So if you look at it like there is going to be some great companies coming on sale, it can be a tremendous opportunity. So there's always two sides to that coin.
Yeah, really.
The market, like when I look at macroeconomic risks, market crashes, these are risks that are unavoidable. Yeah. And it's just really part of investing. It's something that you have to learn to accept. You have to learn to navigate. Obviously when they happen, they can be very stressful, but they're really unavoidable. For me, I would say company specific risk is probably what I would focus on more, because that's actually something you can avoid. So your fear there is, or at least you can mitigate a large part of it with good research. So at least your fear there is put to good use, right? You can scare yourself into putting in the work that's necessary to make good investment decisions.
Yeah. And again, we talk about that sweet spot of buying 15 to 25 companies. Doing the research on each of those can help allay that risk. But also, if you're going to hold 2 or 3 companies, it's not a smart portfolio. It's not even a portfolio. It's not a smart way to invest. Again, 50, too many, but down to 25, you're going to get a reasonable amount of diversification, all that you really need. And you can help allay that company-specific risk. If one of those companies that even if you did all the research in, something happens that's unforeseen, then it's one of 20, 25 companies. You can handle it in a portfolio. Not if it's 1 or 2 or 3.
Yeah, and I would really say that on the inverse side, the missing out on opportunities, a lot of times that you're just investing in overvaluation companies. You're just paying too high of a price when you're really adhering to that fear more than anything. So like in 2021 or late 2021, early 2021, we saw the market just shoot way up. People were, I need to get in the market now. The market's going crazy. And then it took 2-3 years for the indexes to recover. And many of those big names that were just the headlines at the time, they're still down 80%. And that's really when you're succumbing to your fears. You're paying 200 times earnings, 100 times sales, whatever it happened to be at the time. And that's a very easy one to really ignore. Is you have thousands and thousands of chances for various companies. You don't need to make a decision necessarily. And that's what we do when we were just saying, monitor, we can wait it out. You have tons and tons of choices coming down the line. You don't need to really fear. There's always going to be opportunities is the point.
Yeah, the same fear of missing out happened in the .com boom. And you see that in sectors too, when they get extremely hot. We saw that in the cannabis sector. You've seen that in certain commodities, even over the past couple of years, where you've seen a commodity price go sky high. I mean, I'll talk about a company today. They don't produce anything, but they were tied to the price of lithium, went sky high. It's dropped and the stock is significantly down. You have that euphoria in the sector, fear of missing out, people buying at any price. Got to pay attention to cash flow. All right. So I think that'll end that segment for this week. We've got, I believe, 4 your stock our takes for this week, so we might as well get right to it. I'm going to start. I will preface this brief review by stating that what I did the exact same thing last time as we reviewed the stock. We base our recommendations at Keystone fundamentally on, even in the small cap arena, on a strict criteria of fundamental cash flow. We are looking long term. We are investing in this business, in businesses that we do for our clients, with a strong current growth profile and a high probability of growing that cash flow over the long term. This will drive share prices for our clients over the long term. As always, again, we're happy to see the engagement with some of these posts. As you can see, the stock price initially went higher from when I reviewed it after a question that we received on the podcast. It went from $7 to just under $17. Now, here are a couple. Now, of course, it's returned to the $4.56 range. It's actually down now 32% after we called it a cautionary investment at that time. We were cautious. We had a cautious stance on the company at that point. Now, here are some of the comments that we received. You can see here, I can read through this. When analyzing this company in depth, it's currently one of the largest lithium discoveries in the world. It is also a super tight share structure, unlike most mining companies and exploration companies. It just raised $20 million a few days ago at twice the current share price. That is because the smart money knows what they're sitting on. Just because the share price has risen a lot does not mean it is an overvalued asset. On the contrary, it is still very undervalued. This time next year, the stock will be worth $30. Most people miss this plays like this because they get in too late. Just look at Great Bear, blah, blah, blah. 50 cents to $30 in a couple of years. They have mined, blah, blah, blah. Now, again, this is kind of missing the point of what I'm talking about when I talk about a company like this. It doesn't make our initial criteria, which is cash flow, so we cannot invest in a business like this. And it's not that I was saying it was overvalued or undervalued. It just doesn't make our current or our criteria for initial investment. Again, here's further comments. Initially, again, the stock went higher, but now it's down 32%. And they gave their opinions here saying that didn't age too well. Now, I guess I could sit here and say and dunk on this poster and say, now the stock is down 32%. So who is right in the long term? But frankly, that's not the purpose of our podcast. What we're trying to convey here, is really our investment philosophy and why we utilize it and try to educate investors as to why we see it as a more successful model, particularly for investors looking to try to find long-term winners, stocks that can truly change their portfolio, because that is the blue sky potential that anyone is looking for when investing in these junior exploration companies. We believe, and we've seen it firsthand, that you do not have to take the level of risk inherent in these types of ventures to achieve the returns, even the 10 times returns or at least companies that have potential of achieving those type of returns that most investors who invest in these companies, or they call it investing, they speculate in these companies, are looking for. Now, I've been doing this for around 25 years, and the amount of long-term successful mineral exploration companies is very low. And the success in picking winners in this sector is more random chance than anything that can be applied with any quantitative or qualitative investment model that I'd feel comfortable with using. I hope this slide that I'm going to have next here helps to illustrate why we focus on profitable businesses. Not that slide, but this slide here. And illustrates why we focus on these profitable businesses versus speculative resource businesses. If you see here, this was a study done on stocks. He studied 26,000 stocks from 1926 to 2015, looking for outperformance there. The most significant variable was net income growth. This is why we use this as a minimum criteria in our investment research. And why we look at profitable small caps? Well, if you look at over the last 10 years, 87% of all global equities that went up 1,000%, the type of returns that you're looking for when you speculate in these junior mining companies and don't find most often, but what you're looking for. Those all started as micro caps, 87% of them, micro and small caps. And the key here is 82% of those were profitable at the start of their ascent. 91% had some history of profitability. You're not going to find that in a company like Patriot Battery Metals. The key for us is combining small, growing, profitable, good businesses that trade at reasonable prices, and this is what we do. Proof is in the results. Over the same 5-year period that we looked at Patriot here, we were recommending a company with great cash flow and earnings growth, and you can see the returns in this business. Hammond Power delivered these type of returns with far, far less risk than a company like Patriot, and it delivered these returns. These are the type of returns that every kind of speculative or small cap investor is looking for. Okay, let's take a brief look at Patriot because we got a question on them. What does Patriot do? They're a lithium exploration company focused on 100% owned Corvette property in the highly prospective Itzchi James Bay region of Quebec. So what is driving the decline in the share price? For me, it's basic lithium price drop. You can see lithium was on a strong run from 2021 through 2022. And then in 2023 had a precipitous drop. Now, despite forecast of longer term shortages, which still might occur, this kind of stands as proof of the unpredictability of commodity prices generally and the inherent risk of investing in stocks based on a volatile commodity. Now, we can look at the financial statements of this company because that is the way when we get a question, the first thing we do is we look at the financial statements of a business. You can see over the last 8 to 10 years here. I mean, obviously, we wouldn't expect to see revenues in an exploration company, but that's what we see here. And obviously, you can see the operating losses of the business, which would have Patriot not meeting our initial criteria. The balance sheet is fine. There's a strong net cash position here used by or achieved by raising equity, obviously. But there is a net cash position. They will need significantly more capital to actually ever bring a mine to fruition. So our conclusion here is promising project, high risk. The quality, size, and growth of the potential of their flagship Corvette project is high, but the company is well thought of, but the company does not, again, meet our minimum criteria for investment, which is cash flow from current operations. If you're looking for blue sky type returns, there's a better way to do it than speculating on junior mining companies, regardless of the fact that they have a great management team or have cash in the bank or have a prospective project. There's a better way to do it. Find good cash flow producing businesses that trade at reasonable prices and bet on those businesses over the long term, not junior mining companies that have a hope and a prayer of bringing a project to fruition over the long term. That's my soapbox for today.
Yeah, a hope and a prayer. I mean, I think that kind of sums it up. Again, maybe the prayer will be answered, but the risk just outweighs the reward tenfold,
Yeah, and we're bringing statistics forward to show that. Like, if you're looking for those returns out of the stocks that did globally, that did 1,000% over the last 10 years, you're looking at 87% of them basically having net income. Well, an exploration company doesn't have that. So if you're looking for those blue sky type returns, there's the proof in the numbers that this is not the area that you should be looking in. That's what we're trying to say. By the numbers, by our experience looking at the sector, by all means, you want to speculate, but no, it's just a gamble, and likely you'd have more fun going to Vegas, even if it is as hot as we were talking about this past week. You'd have more fun just going there and putting it on black, right?
This hot.
Yes.
Unless you're in the pool, but
it's true. True. Again, this is nothing against Patriot Battery Metals itself. We're not even really analyzing or talking about Patriot.
But it is something against companies with no revenue.
Yeah, it's something against companies with no revenue.
Patriot has no revenue.
And when we do a segment like that, because we're asked almost every week about some junior mining company, and we choose to answer very little of those questions because, we'll answer our clients on those questions because the answer is the same, regardless of the prospects of the individual project or, the company or even management success in the past. Because we've seen management teams that have had tremendous success on one deposit literally crap the bed on another deposit. It can be a different type of animal going from one skarn deposit to another type of deposit. It's not as transferable as, say, like one of our long-term success stories, Boyd, where an automobile repair shop in northeastern U.S. is similar to southeastern U.S. Like it has transferable skills in a management team identifying a business to buy here that's the same as here. There's like to like. It doesn't always happen that way in the mining sector, and without the cash flow, we really have nothing to analyze. So again, it's not anything against Patriot Battery Metal, and all the investors who love this company will be coming after me on YouTube because I said, how dare you say that Patriot Battery Metals is a poor investment? Well, I'm not even saying that. What I'm saying is, if this is the criteria you use to identify great long-term growth companies, you're not going to be successful over the long term. And that comes from 25 years experience and from those statistics that I just put up in front of you. So don't ignore the stats. Ignore me if you want to. Don't ignore the statistics that are staring you in the face. Look for good companies. They have some net income. They're growing it. That's how you get the long-term 10 baggers that people are looking for when they invest in these companies.
Yeah, you can even just, when you had the price of lithium up, you can just see it mirrors the price of the Patriot Battery Metals. Like there's a bit of operational leverage on it, like any miner.
Yeah.
But that's what it's mirroring. That's what you're gambling on. And you can see the EV hyperbolishness that you saw in 2021, 2022, and early into 2023 fell apart. And then now you've seen lithium prices collapse. And Patriot Battery Metals, I don't think they're looking to produce until 2028, 2029. Who knows how many mines and discoveries you're going to have between then and now, and what battery shifts you're going to see then. Are you going to see lithium come into batteries less by then if there's so much research and development being poured into this? Like that's the issue with these. You're gambling 4 years out before even any potential tangible cash flows can maybe enter the space.
Yeah, and you juxtapose that to, like, I put up the chart of Hammond Power there. The stock was then trading with a net cash position. You could have bought it at 7 times, 6 times earnings. There's a growth path ahead of it, a strong dividend. Like the dividend has gone up 270% over that period. Like your effective yield has gone to almost 17% just for the dividend over that period. That is a great long-term growth stock that could be bought at far less, 5 years ago, far less than where many junior exploration companies were trading for that had zero, that had just a moose pasture in Saskatoon. Sorry, Brennan, but a moose pasture there. And they had a valuation of 100 million, and, Hammond Power could be bought, in that range. Unbelievable. You can find great businesses trading in that range versus putting it into a purely speculative company. And this is the point of that segment, and the point when we ever answer a question on a junior exploration company with no revenues, no cash flow. That is the point, showing a different way to invest. And then, of course, many investors or many listeners that are looking at that, or people who pick up on that YouTube commentary on Patriot Battery, miss the plot. They miss the plot completely. The plot isn't really to talk about how horrible Patriot Battery Metals is. I hope the company does tremendously well. It would be great to see that company. It's a great Canadian company. I'd hope it becomes a great Canadian company is what I'm saying. But if we make investments based on a speculation of a company having a future mine, it's not going to do well in your portfolio or for our client portfolios over the long term. We have a different way to invest, and that's what we're trying to show through the podcast. All right, that's enough on that, beating a dead horse. Let's move on. Aaron, you're going to talk about Nikola.
All right, excellent. Yes, so we have a listener question on Nikola Corporation. This is from Simon from Richmond. He's asking, can you please provide a review of Nikola? The stock is up 40% in a week, and I would like to know if there's anything real behind this move. Happy to do that for you, Simon. So Nikola, it's a company that we have looked at in the past. Symbol is NKLA. It's trading at about 11.30. Actually, I think it closed today at about 10.60. And it's about a 500 million market cap company. So what they do is they develop and manufacture zero emission vehicles, primarily hydrogen fuel cell electric trucks for the commercial and transportation sector. And they're also looking to revolutionize the trucking industry by offering not just the vehicles, but also an entire ecosystem or infrastructure of hydrogen fueling and maintenance services and stations. So you are very correct that it has had a fantastic week, up about 40%. I think it was up at one point today. It was up at 25%. Then it pulled back. I think it closed about 16% positive gain. And what really precipitated all of this was they released their Q2 2024 deliveries numbers. And these numbers exceeded both their internal guidance is in addition to analyst forecasts. So that is what has some people excited about the company. But if we were to take a longer view look on this stock, we see a much bleaker picture. So going back over the past year, the stock is down considerably for investors. And we actually did, we've looked at this company in the past, and we actually did a segment on it on the podcast 3 years ago. I don't even remember if we had the YouTube podcast back then. So this goes way back, but it was about 3 years ago where we reviewed the company, and we did not like it back then. So this is a company with quite a history. If we go back the full history of the company, it became a publicly traded company in June of 2020 via a SPAC transaction, and then shortly after trading. Shortly after becoming public, it achieved a valuation of about $34 billion. So a $34 billion market cap. Well, this company had zero revenue. So we looked at the company on that basis, and we felt it was very reminiscent of the dot-com boom, where you had companies with multi-billion-dollar valuations that had no revenue, and in some cases, barely any business model. But shortly after that, there was a very damning report issued by a short seller alleging all types of fraud from the company. And, typically we like to look at those reports and base it off of the research, because sometimes those reports are not very credible. But in this case, for Nikola, the chairman of the company actually resigned 10 days after the report was issued. So that was not a good sign. And since then, it has pretty much been mostly downhill for the company and its investors. And then just recently, on June 24th, the company decided that it would do a 30-for-1 share consolidation. And that's typically what we see when a company has a significant number of shares outstanding, and the share price is extremely low. So that was done, which is why it's trading today at about 10.60 was the closing. But let's take a look at how this company has been performing recently. So I'm going to take a look at the Q1 2024 results. The Q2 results are not out yet. They have released the deliveries, but not the financial results. So during the quarter, they produced 43 trucks, shipped 40 trucks. So the shipments were up from 31 trucks the same quarter in the previous year, but the number of trucks produced were down from 60 to 43. Revenues were actually down in the quarter year over year, 7.5 million compared to 10.7 million in the first quarter of 2023. But one thing I really want to bring your attention to is the gross profit, or shall I say gross loss. So this company has a negative gross margin, and it is a huge negative gross margin, 768% negative. So essentially, every time this company makes a dollar in additional sales, it's losing $7.60 in gross profit alone, right? So the gross profit basically are what is the profit after costs that are directly attributable, variable costs that are directly attributable to your sales of your product or your service. So these are things like material costs, labor costs to produce the service or product, and then any overhead costs that are directly attributable to that product. So this doesn't even include all your fixed costs like your rent, most of your salary. So, seeing a company with a negative gross profit margin is a major red flag. This is not a situation necessarily where more revenue growth is going to get you out of that situation. And in many cases, if this continues, more revenue growth is actually just going to make it worse. So loss from operations in total for the quarter, 145 million. And we can see massive shares outstanding here, 1.3 billion. So huge share structure. I believe this was previous to this would have been previous to the 30-for-1 share consolidation. But the company did, as I said, release their Q2 deliveries information exceeding their guidance. So 72 hydrogen fuel cell trucks were delivered. So that's 80% growth year over year compared to the second quarter of last year. This is what has infused some more excitement into the company, much needed given where the share price has been trending. and people are thinking, well, maybe this is an opportunity for the company to really start to hit that acceleration point. Now, again, the problem that I'm seeing here is that we know that the number of trucks have increased, number of truck deliveries, so we can expect that revenues have also increased, but that may actually make the cash flow burn and the net loss worse, given the fact that they have a negative gross margin. Looking at the balance sheet, one thing I will say is they do have a good balance sheet, $350 million in cash, $282 million in debt, so about $68 million in net cash. Of course, this is not money that they have generated from operations. They're losing money from operations, burning cash flow. This is money that they've raised, but still, the balance sheet looks okay given that it has that net cash. But you're looking at a huge cash burn rate. So negative cash flow of almost $500 million, $450 million over the last 12 months. And this continues. We're expecting the company to continue to burn through significant cash. So their cash balance, given the fact that they also have debt, is not going to last them for very long. We are looking likely that this company is going to go back to the market in the near term to either raise shares through a financing or to increase their debt, or likely both. So our take on the company is that it is highly speculative. That negative gross profit margin is a major red flag. The more money they generate in revenues with negative gross profit margin, the more money they lose, right? So a lot of companies that are reporting a net loss, the solution to that is more revenue growth. But if you're losing $7 for every extra dollar of revenue, then revenue growth isn't necessarily the solution. Substantial cash burn rate, as I said, likely to increase debt, likely to issue shares soon, and also an extremely poor track record of investor returns. I mean, this company, understandably, there are new people in it now than there were back in 2020 when they had those problems. But ultimately, this is a company that made a lot of promises, did not follow through on those promises. I'm guessing, given that $34 billion market cap with no revenue, they were highly promotional as well. So they were really riding the wave of excitement for EVs. But once the market realized that there wasn't much there with the company, the share price reflected that. So we'd be concerned. We don't see any type of good track record there. And just, in conclusion, we don't believe that it's an investable company. Now, things can always change. Maybe they add some new customers, they change their cost structure so they start making money, or at least, transition towards break even or profitability. But there's no sign of that happening right now. So, until we see at least a sign of that, we wouldn't even consider this company to be investable. So I will give the mic over to everybody else, and they can tell me about how I just don't understand the technology.
No, I think that you hit the nail on the head. I mean, again, about a year ago, we did our electrification report. We, I highlighted about 11 electric vehicle manufacturers in that report. Only 3 of them were actually cash flow producing from that report. 1 being from the US, 2 are located in China. But other than that, there was basically no cash flow. Basically every single, little company profile that I did, I basically summed it up with, the company has been funding its operations through a combination of share issuances and debt. And yeah, I mean, there just really wasn't too much to dig into in regards to, good fundamentals or good, financials from these companies. And, even back then, like looking at Nikola, like for, I believe, fiscal year 2022, they ended up burning, I believe, about, over $570 million in operating cash flow. That's a lot of money to be burning through. And like Aaron said, negative gross margin. Ouch. That's not a good sign from a company.
Yeah, I mean, I agree. I think Aaron was too diplomatic. It looks like a piece of hot garbage, to be honest, to me. I mean, they have 32 million in trailing 12 months revenues. And yeah, it's like for the scale this company would have to get to probably to get to profitability is
they're nowhere close right
exactly. Now. Yeah,
Yeah.
for sure. All right.
Yeah.
Oh, sorry.
I was just going to add on quickly. You're probably seeing a bit of a short squeeze too, because it has been a heavily shorted stock ever since the fraud. If you're wondering what the fraud was, the big thing of it was for their initial prototype, they just rolled a truck down the hill and presented it like it was working in a fully functional. That was like in 2017 or something. They actually have models now, but that's what that really was. So obviously, high promotional company. I think that really sums up the governance at the time when it was that. I think after the split, $1,800 now after they've consolidated, just to give you an idea of what you were dealing with at that time.
Yeah, another example of, you're talking pre-revenue businesses, even if they get to some revenue, the challenge is on the way. Well, I mean, this is fraud involved, to be honest, but it's a challenge just to get to a business that actually produces cash flow, and then that's going to drive the shareholder returns. A cautionary tale again. Let's move on. Brett, we'll ask you to look at Pollard Banknote.
The irony here is this is a gambling company, but it's somehow profitable. There we go.
There's money in sin stocks.
Exactly.
So Brennan's a customer.
I can't say
Brennan.
Not much of a
gambler. I don't believe he is.
No.
He is.
In all the other sins except gambling.
Wow.
Of course.
I'm just kidding.
So Pollard Banknote, Pollard symbol PBL on the TSX, serves the lottery instant ticket and shareboat gaming markets, primarily in North America, but they do actually have some exposure to Europe now. It is one of the largest printers of instant tickets in North America, with operations in both US and Canada. The company also serves the US iLottery market through its joint venture with Neo Games through this Neo Pollard joint venture, of which it owns 50% of, and that's really been the story of the stock over the last couple of weeks, and we'll get into that. The stock is trading down, however, 11.6% year to date at $29.09 a share, with a market cap of $787 million. The company does offer a small dividend of 5 cents a quarter at this time, which comes out to a yield of 0.7%. Not substantial, but it was increased from 4 cents per quarter in the prior year, and it was kind of flat for about, I think, 5 or so years prior to that. So eventually, if they do keep growing the dividend, it could end up becoming really a dividend stock. We don't really consider it a dividend stock until about that 2% or so, as really below that is just really a token. It's a nice little pocket change, if anything. You're not investing for the dividend, but it's something nice to happen. But if it does keep on growing over time, you can eventually see it turn into a dividend stock. The stock did tumble 10% or so in late June, and that really can be attributed to the Neo Games joint venture. As Neo Games, they actually really split off kind of what they had within the joint venture before. So Neo Games really, it was acquired earlier this year, and they have shifted really their strategy when it comes to their joint venture with Pollard. So within their New Hampshire contract for iLottery services, Neo Games has now went on it alone instead of within their joint venture. So effectively, they took the lion's shares of the contract, or all the contract, instead of just the half what they were seeing before, by providing their iLottery services. So while the New Hampshire contract in isolation really isn't significant, it really does signal a shift in strategy. So instead of them funneling into a joint venture with Pollard, they are just going at it alone. And really over time, I would expect it at this point to see a whittle away of that joint venture as those contracts do come up for expiry, and they're directly competing against each other between Pollard and Neo Games. So really competing against a former partner. At this time, it's really increasing the risk level, as we're not certain. We don't know if the joint venture is just really going to fall apart. That's something which we need to wait on management commentary for. That'd be, if we do reach out and call, that'd be something we ask, is how they see the joint venture either unraveling, or is it going to continue as a one-off? But it does increase risk is the point. And that's really why you're seeing a 10% drop in the stock price, is because heightened risk, you need a heightened reward, which means at the time the stock price has to drop. So switching to the company's financials for Q1 2024, the sales were materially flat at $126 million, but gross profit did increase to $21.5 million from $17.7 million, and that's gross margin increased to 17.1% from 14.1%. The increased gross primarily was due to increased licensed products, retail merchandising products, and e-gaming system sales, which are at a higher margin, as well as higher instant ticket margins due to increased pricing. And they are expecting that increased pricing to continue throughout the following year as they were battling with inflation costs, which previously decreased margins. However, moving down the income statement, we can see the equity investment income of 12.2 million. This is from that joint venture with NeoGames for the various iLotteries. It has seen strong growth in prior year from 8.2 million. And worst case scenario, we take that down to zero. I don't think that's going to be the case. That would assume that they lose 100% of the iLottery contracts and the joint venture implodes, which I don't think is inherently going to be the case. They would likely be near break even, if not at a slight loss for operating profit, depending on exactly how it shakes out. But like I said, I don't think that's the case, and it plays out over a long period of time if it were to be the case. So Pollard will likely as well compete for those contracts because it acquired in 2021 Next Generation Lotteries for $50 million, and they provide iLottery services. That's where they have that exposure to Europe at this time. So you're likely going to see maybe a haircut. It's going to be increased competition within iLottery services within the US. That's really something we need to see play out over the next 5 to 10 years as these contracts for the various states come up for bidding wars again, effectively. The resulting of the bottom line, though, at this time is 6.9 million, up from 4.8 million, or 25 cents per share from 18 cents per share. Overall, strong year-over-year growth from the bottom line, but that top line didn't see any growth, which is a bit concerning as demand for the services or the lottery tickets has been a bit weaker. However, shifting to the balance sheet, the company holds cash of 6.6 million and has debt of 111 million with debt leases of 90.9 million, resulting in a net debt and lease position of 125.5 million. As well, the resulting trailing net debt to EBITDA is 1.3 times, which is fine given they have long-term contract-based sales with the states. So that's not an absurd leverage ratio. And as well, I would, assuming they don't do any additional acquisitions, this just to come down over time, as both EBITDA would be expected to grow, and as well if they decide to pay off the debt instead of just rolling it. Shifting to valuation, the company does have a bit of a high valuation, but it's not absurd. The company has a trailing GAAP P of 23.8 times and an EV to adjusted EBITDA of 9.5 times. Neither of these are particularly cheap, though, either. With a good bottom line growth over the past year, that is really due to margin expansion over both and as well it has the equity income as well. The margin expansion is good to see, but it doesn't really support a higher valuation until you see that top line growing as well. You need both to really have a premium valuation, which they have had historically, but at this time it has lowered, but it's still not exactly a cheap valuation when you're comparing to companies outside the industry. But compared to its historic of 30 times for PE, that is a bit cheaper, so it is looking a bit more appealing than what it was on a pure valuation aspect. So really concluding, while the impact of the NeoGames acquisition will likely negatively impact Pollard, it will take place over years, if not a decade. As the various contracts expire, there is no guarantee that the JV will come to an end, as there has been no announcement. That would be something we would ask about with the management of Pollard if they do see it coming to an end, given now the strategy change from NeoGames. So the risk is higher, but that's by no means an existential risk for the company. But we do need to consider that in the valuation of the company, which isn't an extreme discount, but I would say at this time it is on a bit of the lower end of the fair value. The company has traded at a historic range about 30 PE, so it is lower, but the risk is higher given the JV circumstances, and it is hard to justify a massive premium valuation when risks are heightened. If the top line growth is able to return and to that low double-digit average in tandem with that physical ticket sale margin growth, a case could be made to take a long position as the business will likely perform over long term. It's a defensive industry. Lotteries aren't going away in whatever form, if it's digital, physical. It's going to stay around whether or not you agree with it or not. So, however, it is not just that screaming discount. It is likely just on the lower range of fair value given this recent share price decline. So for now, I'd really monitor the company for that better risk-reward trade-off. If it fell like another 10, 15%, if the market really overreacted to the NeoGames joint venture, if you did see that where it drops by 50%, which sometimes the market does really overreact, that could be an opportunity for the company, as I do expect it to perform at least decently over the long term. But for now, I would just monitor and wait for a bit better of a risk-reward trade-off.
Yeah, I think it's a good summary. This increases the risk if it continues in other, projects going forward, if Neo continues to try to work under that model. But based on earnings estimates for next year, 2025, I'm talking about, it could be getting into a range where it does become interesting if they hit some of the higher end of earnings guidance. I mean, it could be trading at 15 to 16 times, which if it got to those levels, I mean, that's forward looking. But if it got to those, like you said, historically, almost 30 times. So, and there's growth there. So it is interesting. This does add to the level of risk, and it's something we would want to have comfort in going forward. At least the opinion of management is, and based on something that is credible, that this was a one-off, or I know they've developed their own product, I believe, as well, that they're marketing in Europe. So maybe there's going to be some competition there, but we'll see going forward. We'll have to talk to.
Yeah, and I will say, like, over time, like if it was just to stay at this price, and like Ryan was saying, if we go 2 or 3 years forward, we're not stuck to not buying a company like this when you just need to wait it out. You need to see either the risk go down or the value proposition go up, and that just occurs with time. You expect a company to grow, it improves over time if the price stays the same. Because we commonly will have people comment a year down the line, why don't you recommend this? It's a different company day to day. Over time, you want to see that trend.
Excellent. Okay. Should we move to PyroGensis? PyroGensis Canada Inc. It's PYR on the TSX. Brandon's revisiting his take on this business. You've looked at once or twice in the past. I think twice. Have you not?
Yeah, twice. And I think even we've had on the podcast, I think about 3 times.
So keep getting questions on it.
So. Exactly. I mean, it's pretty popular with people I know on the investing boards. There's a lot of people that are interested in the company. So yes, PyroGensis Canada Inc. PYR on the TSX, trading right now at a price of about 78 cents with a market cap of about 134 million. So PyroGensis designs, develops, manufactures, and commercializes plasma processes and systems in Canada. It offers its Droserite, a process for enhancing metal recovery for aluminum and zinc industries, PureVap, a process to produce high-purity metallurgical and solar-grade silicon from quartz, and PureVap nano silicon reactor, which is designed to transform silicon for use in lithium-ion batteries, as well as plasma torches for replacing fossil fuel burners, plasma arc waste destruction systems for waste destruction, and the company also provides engineering and manufacturing expertise. So as Ryan said, I've covered PyroGensis on the podcast back in October of 2022 and in June of 2023 when the stock traded in the $1.06 range. And at that time, I concluded that the company had potential, but to us, the business had yet to validate its business model as it continued to post declining sales and lacked profitability, cash flow, or even adjusted EBITDA. And as I said, someone could speculate on the business, but again, to us at Keystone, the investment case was just too early. So let's take a look first at the financials to see if the company has fundamentally improved from a year ago when I covered it last. So for the last quarter, Q1 of 2024, revenue was up 34% to $3.5 million, but the increase was primarily due to the depressed revenue that it generated in Q1 of 2023. And if we look back to Q1 of 2022, the business actually did about $4.2 million in revenue. Now, net loss was a loss of $4.4 million, or a loss of 2 cents per share, compared to a loss of $6.1 million or 3 cents per share in Q1 of 2023. The company still isn't able to produce positive adjusted EBITDA, losing about $3.2 million in Q1 of 2024, compared to a loss of $5.8 million last year. And as well, cash flow from operations was also a loss of $2.8 million compared to a loss of $6.5 million for the same period last year. So the company continues to burn through cash. And looking at the balance sheet, its cash balance is down to about $170,000 with debt and leases of $10.6 million, providing a net debt position of approximately $10.4 million. So given the business is burning cash, how has it been keeping the lights on? Well, as you can see, the company had a net cash position of $23 million in Q1 of 2021. But over the years, the company has moved into a net debt position. So the company has really been draining its cash balance, has been taking on more debt, and has been issuing more shares, as you can see here. with my little chart, now up to 179 million common shares outstanding. And given the dwindling cash balance, debt on the balance sheet, and lack of profitability, I would assume that the company will need to issue shares once again in the near future to keep the lights on. Now, looking at the company's backlog, as at May 2024, it was 28.1 million, which is expected to be recognized over a max of 3 years. And this is down a few million from the same period last year. And because of the lack of net income, EBITDA, and cash flow, we can only value the stock off of revenue, which right now it trades with a trailing price to sales multiple of about 10 times, which is down slightly from the 11 times from a year ago when I covered it on the podcast last. Now, if we did expect that all of the backlog can be realized in 2024, the company would still trade at about 4 times forward 2024 sales. But again, backlog is expected to be realized over a max period of 3 years. So this is likely very aggressive. So at this point, the risk continues to outweigh the potential reward for an investment. And we would continue to classify the stock as speculative, given it continues to lose money, now has a net debt position, and will need to service its debt while it remains cash flow negative, and will likely have to issue more shares to keep the lights on. Now, again, for the PyroGensis speculators out there, this is not to say that the stock will not do well over the next 3 to 5 years. And I hope for you that the stock does do well. There could be a significant contract announced and potentially an inflection point in the business's revenue and cash flow. But to us, this is just speculation on what could be. And for our growth at a reasonable price, or GARP investment philosophy, we would not recommend the stock to our clients. Now, this YouTube comment from EE7369 that was posted on my last update a year ago addressed the fact that I mentioned the business model has yet to be validated due to the lack of profitability. And he said that he finds this funny given that by avoiding the stock while it continues to burn cash, we will have missed the major initial run. Now, this is something that we hear over and over and over again. But by building your portfolio with stocks like PyroGensis that continue to lose money, take on debt, and dilute shareholders, it's a great way to destroy capital. Like Ryan quoted today in his segment, from the Hendrik Bessenbinder study, which looked at 26,000 stocks from 1926 to 2015, 82% of stocks that went up 1,000% were profitable at the start of their ascent. So hopefully that hits home for you. 82% that went up 1,000% were profitable at the start of their ascent. And now just this other comment here to respond to Thoughtful Aquarius. One could analyze a company's qualitative factors for days on end, but at the end of the day, growth and profitability are what drive shareholder returns. And until PyroGensis can prove that it's on track to validate the business model and grow earnings per share, we believe that it's a good idea to avoid the business. So yeah, that's my segment. Realistically, I'd say, the fundamentals are just kind of getting worse and worse. I'd say, backlog's down a bit. They're now into, more of a net debt position. And we're really not seeing like cash flow really trend towards that break-even point, which, we really like to see. But yeah, now I'll open it up to you guys if you have any comments and whether I just don't understand the technology.
You don't. You never do. No, so on the balance sheet, something which they did do just on July 3rd was they lowered their warrant repricing, which is effectively them signaling we need to raise money. Because normally you would see a warrant like that. It doesn't make sense for the company to lower a warrant if they don't need to raise money. Yeah. It's really just giving away free money at that point. And they lowered it to 75 cents, and it's roughly trading above it. I think right before they did it, I was trading below it. So likely at 93.75 cents, they can accelerate it. So if it hits that point, that is there. We are diluting point. It ended up being, I think, just under $4 million at that point, and that will give them another couple quarters of runway. And that's really just to shave off those warrants instead of just diluting directly on the market at a lower price. And that's really concerning when you're seeing stuff like that. It just means they know they're not going to have the cash flow incoming from their operations. likely in the near future, they don't want to do any bridge financing with debt or any short-term note and get a better rate. No, they're going to dilute the equity, which is a higher cost of equity than debt. So they're not really expecting that return on company capital at the time.
Yeah, that's a good point, Brett.
Yeah, when we met with management, the story sounded good, but a story is only a story, and until you see, see actual orders, you see a backlog, then you see that converting to revenues and cash flow. And the company has had minor success in that areas, but in terms of revenue, but nothing close to what would meet our criteria at this stage. And there's no surprise to seeing the stock suffer since it hit those kind of pandemic highs. It just didn't deserve to be there to start, and then now is still at a level at 10 times sales. I think you said, Brennan, that you're building in a lot of future sales in the business right now that aren't there and aren't in the backlog at present to justify the price, even at these prices.
Yeah, just even if you're looking at something like 10 times sales, that's what you expect from a high growth software business, not a 20% gross profit business. Even if they've previously been higher in the 40, I think they had a 70% quarter, but I think that had some weird anomalies in it. So, but even if they got to 40%, you're looking at a couple times sales, 2-3 times sales for most companies like that, not 10 times. And even Brennan's generous. It's likely more 10 times sale in reality at this time, not 4.
Yeah. Okay. Well, I think that will close off our segment for the week. I just wanted to say, keep your questions coming into our Your Stock, Our Take segments. If you want us to review a company or review a strategy in investing that you're using, any questions that involved in the investment theme or arena, we will answer those questions. If you're watching this right now, smash that subscribe button on YouTube. If you're listening to the podcast wherever you enjoy listening to it, whether it be iTunes or wherever you enjoy or consume your podcast, rate and review us. As I say, always we're looking for positive reviews. Thank you, and profitable investing.
Thanks, everyone.
Thank you.